Welcome back, investor, to another episode of, wait, no, that's a podcast. Welcome back to Relax with Rise. It's our twice monthly, once a weekly, whenever we get around to it, relaxed discussion on real estate stuff so you can get to know us better. It's always good to get to know people better before you invest with them. So this is an opportunity for you to hang out with us in a super low key kind of way. We're going to discuss some important stuff and then a little bit shorter format, a little bit more bite-sized pieces. So Zasha and I are hosting today. Zasha from Hawaii. What time is it there?
8 o'clock, just starting off.
Yeah, so this is not a lunch and learn if you're in Hawaii. Yeah. How about you kick us off and let us know what we're talking about today?
Perfect. Yes. So a lot of the questions we've been getting are how to, mitigate some risk, because last year kind of was a whirlwind in all markets. And so people want to save their assets. So what we are going to be talking about today is 3 of the top 5 ways to, manage your risk and kind of help you safeguard your assets, whether you're kind of just starting out or you're experienced like us. I mean, we're always looking for ways to invest better. So some of the ways that we've talked about before and that have helped us diversify is trying to figure out, do you want to be passive or active? How much time do you have to dedicate to actually investing? And then when it comes to time as well, is there a short or long-term investment you're looking for, or both? And for us, I think, we want to work towards being more passive, but we are on the active side as far as managing the fund, but we do have passive investments as well that are short and long-term. So when that comes into play, we're talking about equity and debt. For me, I'm still wrapping up a bunch of flips that I have going on here in Hawaii that kind of help me with my active income. And so by investing in commercial real estate, I'm able to be a little bit more passive in that aspect, and then invest into a different type of asset so that I'm not so invested into one thing.
I agree. I definitely do a split between active and passive income. And one of the reasons for that is, as an active commercial investor, I talk about this a lot, I get paid last. So investors get paid first. So not only does it take longer to stabilize the property than it does with a smaller asset, single family or something like that, the investors rightly get paid first. And so for the managers, the general partners, it's usually more of a long-term play where we're looking for back-end profit when we do a refinance or a sale, something like that. And you may be asking, like, why do we sell the asset if the buy and hold is a thing? Mostly just because commercial loans only have like a 3 to 5 year timeline, and you're constantly in a refinance cycle. So you can't just get a 30-year loan and hold it forever the way that you can with residential properties. And so for my active investing, it's a more of a long-term play. And so I like to do the passive investing because if the investor gets paid first, I want to be that investor as well as the manager, because then I'm able to kind of hedge between those two things. So diversifying across the time that you're spending and thinking about not just the time that you're spending passive and active, but the time that it takes for the deal to actually start paying you is an important consideration. Like, when does this thing start cash flowing? And as a manager, like I said, it's a long play. The bigger the property, the longer it takes for us to start getting that cash flow. So I really like my hard money loans, because then people just pay me either monthly or quarterly, depending on the terms that we work out, or just pay me a chunk after a 6-month deal. I hold a lot of private notes. Like, I will buy a single family house and I will just fix it up, put it right back out on the market, but then I'm offering a note. So I am holding that note long-term as the bank, and that just immediately cash flows. So I have a lot of different things that I invest in based on the time that it takes me to start seeing the payment, either short to long term. And so diversifying your across time is a really important consideration that I don't think was talked about when I was first starting out in such an explicit way, to say, like, you need to think about your time horizons. They're always talking about, like, how much money you could make, or your goals for retirement and all of that. But I think when a property starts kicking in, or a deal starts kicking in, actually paying you is an important consideration to be aware of. And when I first started, it didn't matter. My husband had a W-2 and I didn't need any of that money, so I just kept reinvesting all of it. But then when he left his job, we had to start living off of our investments, and cash flow became a very important consideration for us. So I had to get ready for him to leave his job by doing more diversification based on time than I was when I was just building and didn't really need the money.
Well, and that was my biggest, concern initially was, okay, if I'm an active investor and I invest into these longer term commercial deals, how am I going to pay for my monthly expenses or my daily expenses? And so really being mindful of that, but also on the flip side, like you mentioned, I wish I knew when I first started learning about investing that there was passive ways. I always thought to invest in real estate, you have to fix and flip, you have to be active, and then you buy your own rentals and you kind of do it on your own. So once I learned about commercial real estate, that really opened up my eyes to, hey, like you can actually partner with other people or invest with other people into these bigger projects and make, kind of similar returns while being less active in it and spending less of your time managing it. So that was a huge realization for me and really was a game changer to why I shifted into commercial real estate.
That's a really good point. I feel kind of lucky that when I started out, it was early 2018, and I joined my local real estate club. And one of the very first one I went to was a syndicator who was talking about a deal that he had that he was raising capital for. And I was like, what is this? Right? I'd never heard of it before, but it was my first meeting. And so, and I knew that where my husband grew up, it's a college town, but it's still a small town, so it was a lot of farmers, like the rich farmers type of thing, and they owned a lot of these smaller apartment buildings that the students would rent out to go to college there. So for me, it wasn't a strange concept that a single individual could hold a 12 or 15 or 20 unit building. But the thought when I was listening to the syndicator talking about a 200 unit building and that he was bringing investors in to partner with him, that really opened up my eyes. And he said right there, he said, if you can skip over residential and go straight to commercial, I recommend that you do that. I kind of disagree with that now. At the time, I was like, well, I'll just skip residential and go commercial. I have gotten a lot of benefits out of my residential portfolio. But at the time, I raised my hand and I said, well, what do you want to do long term? Like, this looks like a business. It doesn't look very passive. I don't know where this idea came from. It was my first meeting. And he said, well, eventually I just want to be the person who puts the money in the deal. And I said, so if you could put the money in the deal now, skip residential and skip commercial and just go straight to being the money partner, would you recommend that? And he goes, yeah. So that was my very first introduction to passive investing, commercial real estate, and the whole idea. So I do feel really lucky that from the very beginning, I was able to start thinking about these types of things. Nobody really said it explicitly, but it was something that was right on my mind. So I don't really feel like I wasted a lot of time early on, except I was 40. That's the time I regret, was not getting started. But when I did get started, all of this was kind of there from a good real estate club. So that's the power of networking right there.
Right. And even for me being an engineer, I could have started investing passively while I was working. My thought process was if I'm going to move to a different field, like I have to quit this job because I have no time already. I'm already working 60 to 70-hour weeks. How am I going to get into something new and have any time to do it? And so that's one thing I look back on. I'm like, man, I wish I would have started while I was working full time because maybe I didn't have to quit my job so soon. But, everything happens for a reason. And that's why we're here to kind of share our experiences and help people, diversify, get into investing, and make sure that they are managing their risks as well.
Yep. Especially after last year and the conferences that I've been attending this year, I'm asking everybody, like, what have you learned? What deals are going well, what deals are not going well. There are always going to be shifts in the market, shifts in the economy, and what happens is people, including me, get scared, and we don't want to make a move. And it takes a lot of bravery to be able to make decisions in an uncertain type of economy. And so we've got the election year, we got weird interest rate stuff. We're coming out of the pandemic. It's definitely what Warren Buffett said: when others are running towards something in greed, that's when you run away from it, and vice versa. So as people are feeling more unsure and uncertain, that's when I start feeling like, well, there are deals coming up. It's just sometimes you don't know exactly what those deals are going to look like because something new will kind of emerge. But that's one of the things I love about real estate, is it's kind of rinse and repeat type of business. You don't have to come up with the next big thing. You just keep sticking to the fundamentals. The details can be kind of creative, and the details can be innovative. Like, you know, you have doorbell cameras on all your apartments, and embracing tech and that kind of stuff, and embracing, you know, automated property management. That's where we get clever. But the fundamentals of the deal itself, it's a building that's made out of sticks and wood and, you know, rocks and concrete, and people live there or they work there. Like, that's the fundamental of real estate. And so I love the fact that you don't have to be a genius to pick up on, you know, what's coming up in real estate. You just pick something in a good location, a good thing that you feel like people actually live or work there, not out in the middle of nowhere. Those kinds of fundamentals, and you can pick up deals. So during that uncertainty, people are drying up investing. Last year was the lowest transactions in multifamily in the previous like 10 or 12 years. People are definitely slowing down, but that means that deals are starting to pile up with a pent up demand. So you need to be ready to diversify as opportunities come up, because they're coming. And so managing that risk is that willingness to be able to get in the game or stay in the game when everybody else is feeling uncertain and not taking action. Is the best time for you to figure out how to take action.
Yeah, definitely. Well, and that brings us to the next one. The next way is the types of investment that you invest in. And so that's why we felt it was important, even for you had prior experience, you know, investing in debt. So, I mean, lending out, you know, kind of being a private lender. And I had a lot of experience being on the other side of things where I was, you know, raising money from everyday people, and they were lending and they were getting interest. And I always thought in my mind too, man, like, man, I'm dealing with all these contractors. I got to find the next deal. I got to keep my, you know, my team and people, you know, busy that are working for me. But it was always, I always wanted to be on the other side, right? Like,
Mm-hmm.
man, one day my goal is just to be a private lender at the end. I just have my money working for me, and it come back in with little babies, right? And make more money. And so
Yeah.
that's why I feel like it's important for people to know that investing in real estate is definitely possible and definitely should be on your radar as far as one of the strategies that you implement, whether you do it on your own or invest in with other people in a fund like ours.
Yeah.
But it definitely helps to mitigate risk, because now you're lending on these faster projects, right? Versus projects that may take a while. So we're talking about lending on real estate, residential projects. And so typically we see those take 6 to 8 months, sometimes a little bit longer, versus investing in just equity deals, which is fine for the long term. But those usually, you know, you get maybe little payouts throughout the first couple of years, but you're really waiting till the third to fifth year to see that money back. And so if you are depending on those funds, then, you know, investing in debt is definitely a faster way and a way to diversify and see, even if you like that, you may find out in the end that you might be making more doing it that way
Yeah.
too.
And this, when people hear about diversifying across types, they're thinking like, well, over here I'm going to get some stocks, and then I'm going to get some crypto, and then I'm going to get some treasuries, and I'm going to get some rental houses. And inside of real estate or inside of stocks, you know, the stocks are like, you know, mid cap, large cap, you know, foreign, that kind of stuff. And so you can diversify across paper assets. And people think kind of the same thing across real estate. I'm going to diversify across different real estate assets. I'm going to get warehouse, I'm going to get storage units, I'm going to get apartments. And you can't be an expert in all of those. And so you maybe pick one that you're going to be an expert at. Most people choose to have a small portfolio of rental single families or duplexes because they can manage 3, 4, 5 units. Most of our investors actually have a couple of rental houses already, and they know they want to go bigger and they want to scale, but they do not want to become commercial real estate experts. So you're going to pick the one thing that you're going to do that you're an expert at, and then passively invest in other people's deals. But sometimes people don't think about type of diversification. It's not just building type. It's also the type of deal structure. And that could be either debt or equity, short or long term, those types of things to consider. And it really depends on your goals. If you're looking for income right away, in my experience, the fastest thing to start cash flowing is notes, either private lending or something like that. and smaller residential stuff. They cash flow pretty fast because there's less construction. You can get a tenant in there faster. So they cash flow earlier, usually more often and more consistently. So that's why I include debt in my portfolio. I borrow money to do my projects from investors. I also lend out my money to other investors to do their projects. So being both a borrower and a lender is one way to participate in the debt and lending market. So private credit markets, private capital markets, whatever you want to call it, as well as thinking about what kind of building am I actually buying. So one example is the deal that we have available right now, where it's self-storage, which is a great diversification play, but it's a loan. So we have an investor who purchased a self-storage facility with the intention to make some small value adds and flip it. You can flip a commercial property just like you can flip a residential one. He needed a short-term loan because he wanted to be able to close quickly, because of getting a loan from a bank or from a traditional lender, 60-day close, something like that. And with private money, you can close a lot faster. And then he wants to just hold it for a short period of time, fix it up and flip it. So 3 to 6 months, something like that. And so private credit is a really great option for that. And so what we do is we will fund these larger acquisitions with our investor partners. We'll come into our fund. Everybody's contributing somewhere between $50 and probably an average of $250,000 per investor to jump in on these kinds of deals. And then we issue that debt. We service that note. So it may come with construction money. It may not, just depends on what they need. We go and we visit it. We make sure that everything's going well with pictures and all that before we release any construction funds. So the debt, the reason that it's not that passive, you hear it's passive, you just lend the money out and then you get the interest. It's not that passive because you have to pick the right deal. You have to have a network of investors who need private money. It's expensive money. They're going to pay a higher interest rate for it. And so it's kind of a special type of borrower that likes this type of debt product. You also have to know, like, is this a good borrower? Is this a good project? All of that. And then to be able to service the loan, who's keeping track of whether or not they even made their payment that month? Are you making sure they did the work they said they were going to do before you release more construction funds? So loan servicing, everybody's familiar with that in the mortgage industry. You get those letters that say, hey, you don't have any insurance on your property, and we're going to issue hazard insurance if you don't go get insurance. You're like, no, I have insurance. You got to send in proof of insurance again. That's part of loan servicing, or keeping track of those details that make sure a deal is going well. So that's the part of active part when we're lending, and then the passive part is when they pay you and you just collect your interest. So this is a deal that we have open right now in our portal that you can find out about if you go to partnerwithrise.com, jump on a call with us, and we'll give you the link to sign up for the portal. You go in, you fill out all your documents, and then you're able to get into these deals. We put them in our portal first. People who are already signed up and already have their documents ready, because it's a process. It's not just like a whim, like, hey, can I wire you money tomorrow? No, you have to go through the legal process of lending or investing. So getting in there, getting your paperwork filled out, getting all that taken care of will allow you to be able to jump on a deal when it's fresh, rather than scrambling to get all that paperwork done and then missing out. So that's the deal that we have going on right now. And that's just a perfect example of diversification. It's a short-term hold on a debt note in a storage unit in Texas. So we have different locations, different building types, different deal structures. And that's one thing that you can jump in on right now. If you've never done debt investing before, it's a great way to get some more consistent cash flow and earlier cash flow than you would see in some of the larger buildings where you're a partner, more like a business partner, and you're doing profit sharing instead of just being a lender. So if the building's profitable, you get paid. If it's not, you don't. So this is a lot less risk. Speaking of risk mitigation, lending is generally less risky than partnering as a limited partner and investor on an equity deal. So think about debt, think about equity, think about diversifying across all of these different kinds of asset types.
When I like the fact that you get it back in 6 months, especially for this, potentially. So if there is a shift in what else you want to invest in, you can choose something else, especially through our fund. We do debt and equity, which surprisingly, after going to the commercial real estate conference, there was a lot of interest from people, because majority of the time they only do equity because they stick with one thing and that's what they understand. But for us, I think just seeing what's been happening in the market, it's important for us to diversify, not only for ourselves, but for our investors that are relying on us to help with their, look out for the best for them. And that's what is key about, investing with other people, is you have other people, almost like a little community, a little team that's looking out for you too.
That was
So,
one.
and so,
Oh,
oh,
sorry.
no, no, no.
I found the same thing at the fund manager conference that we were at recently, is that most funds are either doing debt or they're doing equity. Most of them are doing equity. A couple of them are doing debt. But I'm sure there are people out there doing both, but that's one of the unique things about the platform that we're using. It's customizable fund. So you can log in and you can actually pick which deals you want. You can opt in or sit that one out if it doesn't meet your goals. And very few people were doing both. And that's why at Rise Capital, we have a team. It's not just a solo operation. And the reason that, like, say, Chris and Zasha are so useful is because, Zasha, you have a lot of experience with building your borrower network. I mean, you're basically having people who are lending money to you for your projects. And Chris was basically running a hard money business with his own capital and had a ton of experience underwriting and servicing those loans. I had a lot of experience as a lender and a borrower, but I was mostly online. My persona was equity, multifamily equity. And as I said it, when we made a fund, I said, I really need to bring in the full gamut of the things that I'm investing in and not just be preaching the gospel of multifamily equity, because already in 2019, there were starting to be some whispers of some cracks. Nobody really knew what it was going to be, but just because it was a bubble. I don't think there was anything wrong with multifamily in 2019, but when prices started to go up, that was the first sign. There's a bubble here. Everybody's talking about it. It's a household name. And I thought, I was already well diversified at that point. And so I didn't feel like multifamily was a huge part of my portfolio, but it was the number one thing I was talking about online. And so when we put the team together, we have a lot of people from different expertise, different fields. And so that allows us to have a diversification fund. And that was the main goal that we had when we set up this customizable fund, was you could diversify in the same portal under a single tax document. So you're not sitting around waiting tax documents for all these little deals. And you're not having to keep track of all these little deals. You can actually diversify across our next topic, the amount of money that you're investing, because this portal that's customizable, you build your own portfolio. You can also choose the amount that you're going to have to go in each deal. Some things that are more risky, you might want to invest less. Some things that are less risky, you might want to invest more. Some things you understand better, you might feel more comfortable investing more. So thinking about the amount that you have to invest is really important. And that's such an individual decision. So Zasha, how do you look at an investment and decide how much capital you're going to invest? Is it a percentage of your net worth, or do you look at your portfolio, or is like, if I really believe in this deal? How do you usually make those decisions?
For me, I just kind of see where all my money is at and what it's invested in already. And if it's too heavily, say, invested into fix and flips or covering my own personal portfolio, then I'll shift more, and I have capital available, I'll shift it more into the passive side. So for me, it's just a balance of active and passive, but also being mindful of projects that I do have coming up and potentially what I would need, or lifestyle changes. Like soon my daughter's going to be graduating from college in a couple more weeks. So I definitely know I'll have to have a little stash away for her for that. Just getting her prepared and moved out of the home.
Yeah.
But more so whenever it comes to the deals as well, I like to kind of look at everything and see, okay, what kind of returns can I get? What is my risk? And where do I have majority of my money standing right at this time, and where should I shift it? So
yeah, what does your diversified portfolio look like? Like, what types of things do you hold? Because I know that you also have an online message that you share, and it's supposed to be, social media gurus will tell you it's supposed to be a unified message, but behind the scenes, that's why I feel like I need to talk more about diversification and how important that is, and get more real about things we actually are holding. I'm sharing those deals in our portal so that other people can jump in on them if they like them. What types of things do you find you're investing in, and what are the pros and cons that you are enjoying or avoiding?
So fix and flips, I think for a lot of those short-term kind of projects have been difficult in the past year or so, just because the market shifted and interest rates are so high. So there's less buyers out there. People are a lot picky and things were sitting for a longer amount of time. And so with any investing strategy, they say, okay, have a couple exits, or, think of different ways. If your first strategy doesn't work out, how are you going to pivot? And so for me, I had to turn some of those into rental properties, breaking even, or maybe, even a little bit less, not cash flowing. And then I also have my current rental properties, single family and small multifamily, that my small multifamilies are doing amazing, because that's when I got them, in 2020, 2021, where interest rates were low. I was really quick to hop on refinancing into the lower rates, around 3%, and then also getting home equity lines of credit against like all my everything that I could. I knew from previous, even my grandma told me, like, oh my God, my interest rate is 18%. It's 3%. You need to get as many loans as you can. Now, not suggesting, disclaimer, anyone to do that, especially right now with interest rates so high. But I think that came into play when other people, like you mentioned, just people around me who have investing for years, 10 plus years, are telling me, do this or get into this type of investment because it'll save you. And that's one of the things when it came to commercial real estate. People are telling me, hey, you have all this active income coming from fix and flips, your rental properties, which I still, a lot of them I self-manage because I rent to people on Section 8 or HUD. And it actually kind of locally keeps me grounded, like takes me back to why I'm doing this, right? And so I feel like that's really important for me. I could hire out a property management company, but I like to be involved and just kind of appreciate where I'm at in life, but also see how I can help them. Or whenever I rent to people, I look at them as a person, not just another paycheck. And so for me, that's really important. And then investing in the commercial real estate helps me to then build wealth for the longer term, because I know the payout may take a little bit longer. So investing in I've invested in 4 different 100 to 200 unit apartment buildings. What else are we in? We bought an RV park with the fund. I've partnered separately on another RV park in an office building, just with some friends. Like, it's pretty crazy to be at this point where, you can just invest into these bigger opportunities with people that are successful in what they do, but also that you've created these amazing relationships with, and you're not scared to talk about money. You're not, I think when I first got into real estate, I was so intimidated, or maybe just was scared to think of what everyone else would think, right? About me talking about money, me talking about finances, owning all these properties. But now, like you mentioned, I share about it because it's inspiring to people. But not only that, like how we've talked about, is you can really make a difference in people's lives by providing the number one thing that they need, which is housing.
Yeah.
Sorry, I got on a
Yeah.
little stool for a
No,
little bit.
well, you bring up some really good points, because we talk a lot about in our team meetings, kind of behind the scenes, like the reminder that you just said, like, why am I even doing this? Because it is a lot of work, and it can be stressful when you're trying to close a deal, and you're waiting for this thing to close so the money can be moved over there, so you close on that one. I mean, there's a lot of just moving parts, and it can be pretty stressful. And sometimes I ask myself the same thing on a bad day, that I'm like, oh man. But above average returns backed by real estate. That's one of our big ones, because I tried for 20 years to figure out the stock market. And what I learned was only 10% of people can beat the market by actively trading in the stock market. And I was like, well, I'm definitely not that finance guru. Like, that's never going to happen for me.
I
And I
did
just
invest in
give up
some
trying.
stock in like Facebook, Meta, and I don't know, maybe like McDonald's. I don't know. Things that I knew, I bought some
Yeah.
stocks in, but that was about it. I have no idea where it's at right now, but
Yeah.
it definitely wasn't my intention to be in it for the long term. And actually, I did it in 2020 when I was bored and everyone
Mm,
was locked up at home. So
yeah.
no real
I,
strategy, but a little diversified there, I guess.
Yes. Well, I'm big in, I mean, that's how I do the stock. It's dollar cost averaging, buy and set it and forget it, long term ETF index stuff. I just went across and I said, well, ETFs, they're what, I don't remember, even 13 sectors is the research that I did. I'm going to get an ETF in each sector. And that's basically where I left it, because I knew that I was never going to get ahead by trying to beat the market and trading for the day or the midterm. I was like, I'm just going to play the index, right? Because most fund managers can't even beat the index. Stock fund managers, mutual fund managers. I was like, I don't want any part of that, right? I don't want any managed fund. ETFs, index, the way to go for me. And so I started looking at like, what can I do that will actually affect the return or the performance of the business due to my actual efforts, instead of fooling myself that I could beat the stock market. So like, what am I good at and what can I actually do? So above average returns backed by real estate, like good management makes a big difference in real estate. Picking the right deal and then running it really, really well is basically how I can turn my efforts into doing a good job of getting above average returns backed by real estate. But the other thing we talk about a lot is risk mitigation through diversification. That's why we structured the fund the way it is, with both short and long-term opportunities and debt and equity between residential and commercial, because there's a lot of diversification, and why I built a team, because I'm not an expert in servicing loans, right? So we built a team of people who have different expertise that we can bring so that we can offer diversification. But that third thing, I don't think we talk about very often. It's the philanthropy and the giving back. And you just really encapsulated, that's most of the reason why we're doing stuff. Like, as soon as you get to be financially stable, what's the first thing you start thinking about? It's other people. And you really have embodied that with your mission in your business.
Thank you. Well, and thanks to real estate, like you mentioned, it's something tangible that a lot of people can understand, but more so, I think being in an expensive market, I do understand that it is difficult, right, to even think about investing when you're just living paycheck to paycheck. So that's why it's so important for me to be able to talk about how you can, change your life through investing in real estate. Or if you have money, like I wish I could talk to my younger self who was working as an engineer, didn't have any time, and was like, hey, put some money away, even if it's, 10, 20, 30,000, like start investing in real estate in some sort of capacity. And, that's why we're here and putting this on. But we only shared the 3 types. We'll be sharing 2 more types in our upcoming webinar, so don't miss out on that. I believe it's May 23rd.
Yep. We do this every 2 weeks. So we'll do one, this 2 weeks we do a relax with Rise, lunch and learn style, unless you're in Hawaii, which is 8 a.m. About normally lunchtime on the mainland. And then every other Thursday we do Rise at night. Basically, it's a hour long, and we really dive into the nitty gritty of the details, because it's one thing to hear the concepts. It's another thing to dive really into the details. And then, you got to take action at a certain point. Like, it's like, I play the piano, and I'm always like, if I tried to learn piano by reading a book or watching YouTube videos, everybody would laugh. That would be ridiculous for me to ever think that I could play piano by reading about it, right? You have to get yourself on the bench and start putting into practice what you're learning by taking action. It's the same concept in real estate investing. And that's why we talked about amount of money. It's a great way to kind of jump in with never invest what you can't afford to lose, right? So you put in a little, you decide, do I like these people? Are they communicating well with me? Do I understand this deal? Are they explaining things to me? Am I motivated to actually spend time researching this and getting good at this so that I can make good decisions? Like, you got to take action and learn a little bit at a time. So the webinar is like middle ground there, more in-depth coverage of concepts. And then we invite you to jump on a call with us, partner with rice.com. We will not put you in an annoying and spammy email, drip unless you opt in and you want to stay in the know. We do send out our deals. Our live deals are coming through our email list. So if you want to see these, you got to be on it. But just, reach out and call. We're not scary. We give you lots of free information in our webinars and in our calls. So would love to connect with you after this one and see you a week from Thursday, in 2 weeks at night.